Good morning, everybody, and welcome to this session. My name is David Bach. I'm the Senior Associate Dean of Executive MBA and Global Programs here at Yale School of Management. I'm absolutely delighted to see so many of you this morning for this exciting session. You've heard a lot in the last day and a half about what makes SOM special, what makes us distinct. You've heard about the enduring mission. You've heard about the close ties to Mother Yale. You've heard about the global network. What we haven't spoken... Oh, well, I was going to say hello to them in a second, but let me sort of make sure people can hear us in Dublin and in Madrid. Dublin, hands up if you can hear us. All right, Madrid. All right, excellent. Okay. All right, good. Okay, so I'll greet them in a second. So as I was saying, a lot of things that make our school distinct, but what we haven't spoken that much about is actually what happens inside of our classrooms. We have a very distinct curriculum, the integrated core curriculum, that doesn't break down content in functional silos mapped on top of PhD specializations. It actually organizes around perspectives that are much more realistic. And in order to make that happen, we have another very distinctive element of our pedagogy, and that's raw cases. And so we're thrilled to introduce this newest, most recent raw case. Now, what's a raw case? And what is a case if it is not a raw case? So the term that we sometimes use to describe more traditional cases are cooked cases. This would be a cooked case from a school a little bit further north. I'm not presenting it as Exhibit A or anything of that sort, but essentially a very traditional case. We tend to think of it as a paper document. It has 10 or 12 pages of linear narrative and some appendices. And I'd just like to ask those of you in the room to raise your hands the last time when somebody came to you with a problem. They gave you 12 pages of linear text with 10 pages of appendices and said, this is all you need to know in order to answer this question. Right? Doesn't really happen that way. And raw cases make use of new technologies to create a much more realistic environment in which to gather information and to make decisions. So raw cases are web-based. They are not linear. They have tabs. You've all been given the login information for this case ahead of time, but if you are here with your iPad or with your laptop and you'd like to play around with the case yourself, there's the URL and the login and password that you need. As I said, it's organized in tabs. The way you move through it is not necessarily linear. You have different perspectives. There's lots of supporting information. There are videos embedded. I'm not going to click on the videos because we have the man himself here in the room. But for example, all kinds of additional information. So if you'd like to know actually what the capital raising offer actually was for Bank of Ireland, you can click on it. And it's right actually here embedded in the case. So there's tremendous information, and students have to make decisions about how much of that information they're going to look at, in what particular order, and how they make sense of that situation. This lends itself and is designed to work with people with multiple perspectives. And that's what we're trying to give you a sense of this morning. I'm absolutely thrilled that we not only have 3 fabulous professors in the room, but we also have wonderful students in Dublin, in Madrid, and of course here in New Haven, as well as the main protagonist of our case. So let me briefly introduce our panelists. Before I do that, though, I'd like to highlight that this case really is a co-production of the global network. You see, if you scroll down, let me just see if I go to the main page, the title page, here at the bottom. You see right here, whoops, right there, that this is a co-production of Yale School of Management, IU Business School, and UCD Michael Smurfit School. And that's something that is also novelty, because these cases are designed in a modular way. Not only can different authors contribute to them, but even different institutions. And if I scroll down a little bit further, you actually see the number of faculty members who've been involved in this from the 3 different institutions. As you know, you can imagine 8 faculty members together. Nothing good will happen unless you have real good coordination, and that coordination comes from our wonderful case writing team John Elias, Jean Rosenthal, who are back there, and their team who really make all of this happen. So applause to you and thank you for your hard work on this. So who do we have with us? We have Ciarán Ó'hÓgartaigh right here. He's the Dean of the Michael Smurfit Graduate School of Business in Dublin. He is also a professor of accountancy. Matt Spiegel, one of our professors of finance, who not only is an expert on security analysis and these topics, but also leads our annual trip to Ireland and actually knows the country and the bank quite well. Will Goetzmann, the Edwin Beinecke Professor of Finance and Management at Yale School of Management and Director of the International Center for Finance, and really one of the main promoters of raw cases and the coordinator of the Integrated Leadership Perspective course here at Yale that pulls together a lot of what happens in the curriculum through raw cases. In Madrid, we have a wonderful group of international MBA students, and the person sitting there in the middle facilitating their conversation with us is Eric Schlee, the Associate Dean of the International MBA and a Professor of Marketing. Hi, Eric. And then in Dublin, we're thrilled to have a wonderful group of students there as well from the graduate school. And the person being with them is Tony Brabazon, who's the Associate Dean for the Graduate School for Graduate Studies and also a Professor of Accountancy. And then, of course, so many different perspectives from faculty and from students. The most realistic one, the one that is really making sure that we're not missing anything here is, of course, Wilbur Ross. It's a pleasure to have you here. Yale College class of 1959, a strong supporter of everything we do here, and of course, the Chairman and Chief Executive Officer of Wilbur Ross & Co. So without further ado, let me turn it over to Ciarán, who's going to give us a little bit of a context. While he does that, I'm going to pass around this book that we got from Stirling Library, which is all about the history of Bank of Ireland. As we talk about the present and future, here's a little bit more on the history.
Thank you very much. Thank you. I'm delighted to be here. And I shouldn't say that Eamon Walsh is here, so I feel like a bit of an imposter, and that Eamon was very much involved in drawing up the case from our perspective with Damien McLaughlin, my colleague in the Smurfit School. I remember, I'll give a potted history first because I think it's important to understand the context here. In that in September 2008, in response to the financial crisis, the Irish government guaranteed the liabilities of what are now called the covered banks, and most of the indigenous banks in Ireland. And this was a significant step at the time in the hope that this would reinforce their balance sheets and halt the flight of capital that was happening at the time. In fact, it didn't, and that meant that by the 11th of February 2009, those banks were needed to be recapitalised, and the Irish government capitalised both AIB, which was one of the other banks in Ireland, the Bank of Ireland, to the tune of 3.5 billion each.
Yeah, so
and as part of that, they were also nationalised, and the government took a significant share in both of those banks. In that context, later on, Wilbur Ross in August 2011 invested 1.6 billion in 35% of Bank of Ireland in particular, which would be generally seen as the strongest of what are now known as the pillar banks. And that was, again, a significant step, and I'll talk a little bit about that context here. The governor of the Bank of Ireland, of the central bank in Ireland, Professor Patrick Honan, who came in after the crisis, has described the crisis as one of the most expensive banking crises in world history. And Wilbur Ross's investment in Bank of Ireland is the largest private equity investment in a European bank. And I remember when I first presented or submitted a paper to a US journal a number of years ago, about 10 or 15 years ago, comparing Irish and US data. The paper was subsequently published, but one of the glib comments from one of the reviewers was that why would I come to Ireland? It's only interesting for holidays. Now we're interesting in Ireland. We might not like to be, but here we are. And in the context of this case, I think looking from an insider perspective, in other words, from within the country, I just maybe draw out 3 questions in the context of the overall case itself, and then maybe 3 observations about what it has to say to us about business education and particularly graduate business education internationally. I'll do that briefly at the end. The I think what's really interesting about this case and is that when you go into an uncertain market, there aren't many people there with you. So there may have been other bidders for Bank of Ireland, others interested, but there wasn't a market necessarily for the portfolio of assets that Bank of Ireland represented. And that creates both an opportunity and a challenge for a buyer. A challenge in the sense that there isn't a market price, and it's not clear what a fair price is, if you like, for the buyer, and an opportunity for the buyer in the sense that there is neither a clear price for the seller and what's a fair price for them. And in that particular instance, I think what's striking about this case is what I call within it what's called the calculation of context, which I think is particularly important. So a lot of the deliberations that went on in this case, I think were actually calculations of context, as well as analysis of the underlying value of the bank and the bank's assets in themselves. And there are three aspects to the case I think draw that out in particular, which Wilbur mentions throughout the case and I think are particularly important. One is the strength of the Irish economy. So Wilbur and his investors looked beneath the headlines and saw that the Irish economy is actually a very strong export economy. The construction, retail, public sector were in particular difficulties, but there was a very strong export economy, particularly international foreign direct investment, the food sector, a very strong underlying economy there that augurs well, if you like, in the context of investing in a bank in Ireland, if not the Bank of Ireland. The second piece, and Wilbur mentions this in one of the videos, is that banks are proxies for an economy. And in this case, therefore, Wilbur was in a sense investing in Ireland, drawing from that strength, if you like. And I think this is, I think, one of the canny calculations of this investment, in that this works both ways, in that the bank was also a proxy for Irish economic recovery. And just as Europe wanted Ireland to recover and had an interest in Ireland recovering, the Irish government had an interest in Bank of Ireland doing well. And I think that's a very important part of this context, in that the investment in Bank of Ireland as the first investment in an Irish bank, the scale it was at, what it signalled about foreign investor confidence in Ireland, is a very important proxy for Irish recovery. And I think that's, as I say, part of the canny calculation, if you like, around this investment. And the third part is that even though this was Bank of Ireland, it wasn't a bank entirely in Ireland. So a very important part of its mortgage book was in the UK. And therefore part of the investment was not only in an Irish mortgage book, but also in a UK mortgage book, which obviously had a very different risk profile than the Irish mortgage book in itself. That brings me to the second part of my observations in the context, if you like, is what I would call the temporal nature of opportunities. In that Wilbur had previously looked at EBS as an investment, which Education Building Society was a mortgage lender, financial institution, which has subsequently been merged into AIB, the other pillar bank, but was a quite significant mortgage lender in Ireland at the time. This gave him lots of intelligence into the Irish mortgage market. They'd also looked at Northern Rock, which gave intelligence into the UK mortgage market, and decided to pass on both, but the information they got at that stage allowed them really to have a much better sense of the investment opportunity, which was Bank of Ireland when it came. And I think particularly for students, what I think is interesting about this is that opportunities which are not for now may be opportunities for later. And research that you do now may be useful in a later investment decision that you make, even if you walk away at that time. And the third piece, and I think this is important in the context of from an Irish perspective, is the negotiated nature of relationships in this context. There is an argument, and it's still only an argument because some of this may play out in court, is that a lot of what got us into the crisis was the negotiated nature of the Irish political system, and of regulation, and of social partnership, for example, which really meant that, in a sense, that government abdicated a lot of leadership decisions, and that those kind of relationships were what created, partly at least, what created the crisis in the first place, including with the regulator, who it is argued, and it is, as I say, still an argument, that they donned the green jersey in the context of the Irish banks coming towards the end or the peak of the crisis. And I think what's interesting in the context of Wilbur's observations in the case is the awareness of this negotiated relationship, whether it's with the unions in the context of redundancy, the context of interest margins, in the context of the ability to make commercial decisions, that there's a context within this that's important to understand not only in the investment decision, but then how it plays out afterwards. And I think having a management team that knows how the world works, doesn't necessarily accept how the world works, but that knows how the world works, is a very important part of that investment decision and a very important part of playing out that investment over time. And that brings me to the third part of what I'd like, or the second part of what I'd like to talk about is the broader implications of this for business education. In that, in the context of this conference, a number of people yesterday, Margaret Warner, President Salovey, talked about the importance in leadership of being aware of human behavior and a much broader set, what he would call the theory of mind, putting yourself in other people's shoes. And Margaret Warner speculated whether business students should know about political science and be political scientists. And I think that's a really interesting perspective from this case, is that political context, that behavioral aspect, that behavioral finance which this school has pioneered in the context of building an investment relationship and understanding the players and the different stakeholders within it and playing that out, that negotiated relationship in that context. And therefore having a wider perspective on business education. As an accountant, I can say that the technical is important, but should be supplemented, not substituted by, but supplemented by that wider information set around human behavior, around how politics plays out and so on. The second piece, going back to the research question, I think what characterizes excellent investors and excellent business schools is the quality of research. And in this case, in the case of the Bank of Ireland case, there is evidence of excellent quality research in the background. And secondly, the ability to act. So not just analyze, but act in the context of the particular investment opportunity. And again, I think for students, it's important to understand that that broader perspective is important, but that at some stage you have to make a decision, and the ability to analyze in that context and act in that context is very important. And the third piece, and I think this is why the Global Network of Advanced Management that we're proud to be part of at the UCD Smurfit School, why a conference such as this or case studies such as this are really important, is that when you're in the maelstrom, you may well be wrong. And I think from my perspective, I've given a perspective from here, but what I think is particularly interesting in this context to hear other perspectives, both from IE in Madrid, from colleagues here, to think about, well, are there other ways to look at the world here? And are there particularly interesting or new perspectives that we're missing because we're in the middle of it? And we are still, in Ireland, the economy is recovering, but we're still in the middle of the maelstrom. And for us, therefore, I think it's really important as a school and as individuals and institutions to have those different perspectives drawing on different ideas and different knowledge sets that may see different things than we do. And I think in that context, particularly interested to hear the comments of others on the case, because as I say, being in the maelstrom, we or I may well be wrong. Thank you very much.
Thank you. So we'll turn to Matt to get a different perspective. And while we set him up, let me say that I accidentally put my faculty password and username for the case up there, so I'm going to give you one. Ooh. And there we go. There you go. Oops. So, talk a little bit about some of the material in the case and some of the perspective I think it gives you on the investment. And we'll see if I can get this little clicker to work. So, you're not hearing? Oh.
This is for recording, so they can hear. Yeah, they're good.
Technology is wonderful, except it usually doesn't work. All right. So how's that? Is people hear me overseas now? Raise your hand. Yes. Do something. All right, good. We're good. All right.
Having used up all my 10 minutes, I'll just wrap up here. Everybody knows all too well, we had this financial crisis in 2007, and sort of one of the interesting aspects of this, which I don't think anybody really understands very well, is real estate prices crash not just in the U.S. but in Europe as well, and in large parts of the rest of the world too. And so a lot of times people blame this institution or that institution for the crash in real estate. Well, on the other hand, whatever institution you're going to blame has to simultaneously work across the whole planet. So it's a little hard to pull this one off. And some people have pointed out, a lot of the models we have and ideas we have don't really hold up. But anyway, nevertheless, whatever caused it, it was there. And so we had a lot of banks and financial firms fail, and in large part, obviously, because of their real estate loans. And that included the Bank of Ireland, about which this case is about. So now financial firms also failed due to the collapsing credit markets and credit-backed instruments, so that actually exacerbated everything. So not only did we have the banks going under, but we had correlated financial institutions go with them. So Ireland's response was, and as the case notes, in 2008, the government announced that it would guarantee not only all bank deposits, but also other bank liabilities such as unsecured and subordinated debt. Now, this, by the way, is, I don't know the exact right way to do it, but sort of a guarantee that was not part of the original contract. That is, when people made investments in the banks, either through demand deposits or whatever, there was no government guarantee at the time that if things went south with the bank, that the government was going to take over for you. So this was sort of an additional thing that they did, and basically what had happened was, as was just mentioned, was this didn't really work in itself, and in 2009 the government announced it would take on the bank's most toxic property sector debts. Now, this was not cheap. If you take a look at the cost per capita, so Ciarán gave the total cost, but the cost per, Ireland's a small country in terms of population. The cost per capita was 24,000 euros, or about $35,000 per person, right? So a family of four was on the hook for 140 grand US. That is a lot of money. All right, so that meant the Irish government, because it doesn't have $140,000 per person, per family, but it itself needs a bailout at this point. And the EU provides funds, and the government tries to sell off the Bank of Ireland as part of this whole package. So basically, they keep all the other banks. Bank of Ireland's put on the block, in a sense, for private investment as a way to get rid of one of the banks. In fact, they're what they presumed to be the healthiest bank. So why buy an Irish bank at this point? So here's prior to 2007, and here's 2007. You look at it, prior to 2007, Ireland looks pretty good, right? It's a pretty healthy economy, in fact. The stuff about the Celtic Tiger was, in fact, true. It looks way better than the European Union in general. In fact, it looks better than the United States in a lot of ways at this point. If you have to bet on an economy, the Irish economy looks really good. So the fundamentals going into the crisis are very good for the Irish economy. What happens? Well, when you spend $140,000 per family, you have a problem. And that's this thing right here. Now, the Irish government, to its credit, having done this, talk about that in a little bit, has worked then very hard to get out of it. And so this is why, this is sort of what you see in the case, is, and they've actually exited the bailout. All right, now let's compare Ireland to other EU countries during the crisis as of 2007. Here's Spain, Greece, Ireland, Italy. So let's say you were thinking of, look, there's a lot of bankrupt banks. There's a lot of these countries that are sort of on the verge themselves of bankruptcy to go with them. Suppose you were thinking, well, where else might I invest, right? Because that's part of the problem that you have here. It's not just the Bank of Ireland. There's lots of targets of opportunity, potentially. So where to go? Well, here are the other countries. And the other countries, you can see in general, except for Spain, look much worse than Greece does, than Ireland does. Like here's Greece, right? It just looks like a basket case beforehand. And so, you know, and what's this? This is Italy. Italy doesn't look good either. And so you might say to yourself, well, gee, their problems aren't that we decided to bail out the banks with a lot of the local money. Their problem is they got a systematic structural issue. And if you have a systematic structural issue, there's good reason to think that the financial crisis isn't their only crisis, right? That is, they could get out of this, and as the case points out, you know, Wilbur Ross says, you're not just investing in a bank, you're investing in a country. Well, you might not want to invest in a country that you think is just due for a series of financial crises. So Ireland looks pretty good on that basis as a target. So one of the conclusions you might have is that what happened in Ireland was a once-off event, right? It was like, there's a crisis, our banks went under, we threw a ton of money at them, and we're done, right? Then we can go back to the way we were, and there's no reason to think that should lead to long-term economic problems. So unlike Greece and perhaps Italy, you're not looking at long-term issues that'll generate crisis after crisis for you. And in fact, Ireland has already exited the EU bailout, which is pretty impressive. Remember that number I gave you at the beginning, 24,000 euros or $35,000 per capita, and to have paid it off between 2009 and today, you know, 5 years or so, that's a pretty impressive amount of money to have pulled off. Now, not all of it was owed overseas. Quite a bit of it was owned internally, so it's one Irish person paying it to another Irish person, which is, if people in economics would tell you, something of a wash, but still a lot of it was held overseas. All right, so I'll wrap up in a second. Here's a quick side note. So one alternative way to do this is what Iceland did, and I got to tell you, it's going to pain me terribly to agree with anything Joe Stiglitz has ever said. And if you look at Iceland, Iceland did something different than Greece. You see this number, this line here? This is Iceland's crisis. And what did Iceland tell everybody? You're not Icelandic? Tough luck. We're not giving you a nickel. And so basically, instead of giving out a lot of money externally, they said, you know, the contract was you put your money into an Icelandic bank. If it failed, it was your problem. And so they only bailed out internally the people from Iceland. If Ireland had done that, how would they have done? Well, there's an argument to be made. If you're looking at this graph, they would have done a lot better. They could have avoided this V shape potentially in that case. You would have heard a lot of screaming and yelling from foreign nationals, but so did Iceland, and you might all notice that Iceland's got foreign investment again. All right, so I will quit here, and thank you. I'm going to need a mic.
I'm going to use this one, actually, to just hand over now to Will Goetzmann, our third faculty expert, and then we'll turn over to students in Madrid and Dublin.
Okay. I might ask a question or two of them.
You should.
Okay. What I'd like to do in my time is there are two things. The first is I'm going to fill in a little bit more about what the raw cases are and how they work. For the students that are here, you already know a little bit about this, but we're very excited about it. And then I'm going to ask a couple of questions, maybe just one question. And you know, usually when we teach cases, I have no fear about cold calling. I'm not going to cold call, okay? But I am going to say that the question that I'd like to ask and give you a chance to think about is a really straightforward question, which is, we have Wilbur Ross in the room, and I see that in Ireland you're sitting at something that looks like a board table, where you're looking like you may be making a decision. And I'd like to know if, I'd like to see if anybody here would have been a voice of contradiction about the decision by him and his company to go forward with the acquisition of the Bank of Ireland. Who among you would make a case to not move forward? And I'd like you to think about what those arguments would be. So I'll leave it at that, and let me get back on track here and tell you a little bit about the way these cases work. The cases always start with an exciting opportunity that somebody has given us in a business situation that allows us to teach not just one thing, but a multiple set of things. So Wilbur Ross was really generous about giving us access to the way that he and his firm thought through this acquisition. So we can cook cases up from the newspaper and so forth, but that's that's only a superficial way of building a case. So it starts with a generosity of somebody that allows us to dig into a story that has potential. The second thing is, almost all of our cases are built around multiple perspectives. And so I'm from a generation that grew up with postmodernism. And postmodernism, you can boil it down to a couple of things. One is multiple perspectives on a problem that may be contradictory. They may tell you different stories. And the other issue is complexity and complexity and contradiction. So they both sort of come from, one comes from the study of literature, the other comes from the study of architecture. But these are useful models for business education because, as David says, the world doesn't come packaged up in 15-page printed documents. So the whole idea of these cases is what you're looking at is a portal into a complicated story and you have lots of information. You've got financial reports, you've got journalists speculating on one side, you've got analysts telling you something else on the other side. We give our students this, what they think of as an incredible mess that they have to deal with when they walk into the classroom. The complexity is made even greater by the fact that it's very difficult for anybody to sift through all of the pages and all of the links and all the information. So we think that this simulates the real world a lot better, and it helps you separate the what from the so what. Now, on the perspective side, we designed our curriculum, redesigned our curriculum around different frames of reference, if you will. It was tough because we had to hammer ourselves out of our silos that are disciplinary and research-based and say, what are perspectives that our students are going to need to bring to bear on decision-making in the real world? And we renamed things. We don't teach marketing, we teach the customer perspective. And we emphasize this perspective in these cases. This notion of perspective flows through these cases. So when you look at a tab, the tab might be the perspective of state and society. It might be an investor perspective, and so forth. So the goal in these raw cases is to get these perspectives built in, and then to challenge our students to be able to quickly change from one perspective to the other. So one of the drawbacks of postmodernism is this sense that everything's of equal value. Sort of relativism is the theme of postmodernism. That's not exactly what our goal is in this way of teaching, because some perspectives lead you down the right path and some might not lead you down the right path. But no matter what, the perspectives are useful tools for framing the problem. Now into this case. If we were, I teach this integrated leadership program class. It's sort of a capstone. At the end of the first year, we sort of ask students to do a set of cases that put all of these perspectives together. So to use this case, for example, for that capstone experience, what we would do is to say, okay, the first perspective might be a simple one. Let's focus on the valuation of the company. You start to unfold how you would actually look at a financial institution. We call it a bank. It's selling insurance products. You start to unfold this, you learn a lot just institutionally about what a financial institution is in this European context. But the second one might be an investor perspective. We then switch over and look from Wilbur Ross's viewpoint and say, well, I see there's an opportunity here, and we might ask, what's the upside? how much opportunity is there? If we invest time, money, energy, are we going to get returns that are commensurate with what we expect as an investor? Okay. We'd switch over to a regulatory perspective. Say, why doesn't the government just take this bank over? Why do they want to have a bank that's left over as a competitor to the banks that they've taken over? Have the students argue through that way of thinking. And then we'd perhaps switch over to something called the employee perspective. For those of you that have seen this case, some of the most moving material are videos of the CEO of the company giving us very honest, straightforward perspective on how he thought about what his fiduciary duty was. And in a context where the whole country is looking at what he is doing and has very strong opinions about whether the bank is doing good things for the country or bad things. So that would be the set of perspectives that we would engage students in for about a 2 or 2.5 hour discussion. Okay, so now I'm going to come back to this question, and I'm going to see if there's anybody that would be willing in this context to challenge the decision to acquire the Bank of Ireland. So feel free to raise your hand. You've got a golden opportunity here. Anybody in Madrid? Okay, I see somebody in the second row.
Okay, is it on?
Yes.
Hi, my name is Christopher Kellicott, IE Business School in Madrid. My question is mostly to do with the confidence that the group of capital investors had to put the money into the Bank of Ireland.
So Christopher, let me stop you here. Are you answering the question or asking a question?
It's why I would have a lot of concern about putting the money in. It's mostly to do with whether or not that 35% of the capital that was private would become nationalized as well if the political winds of change happened to strike the Bank of Ireland.
Great, so you're afraid that you come in as a white knight and then the government says thank you very much and takes the value that you've created. So that's a big risk.
Absolutely.
Okay.
Mute.
Right here? Yep.
Can you actually push the button right in front of you so it gets picked up overseas?
You know, we have to, remembering at that time, Trichet was the head of the central bank there, and he was not, and the situation with the way the thing was run in Europe, was quite anti or was not friendly to capital or to banks. And to see that, if Italy or the other big countries unraveled, Ireland would just go. There was nobody who would help it out in that situation. So my view is that it was a bet, or the only skepticism I would say is it was as much a bet on Ireland as on Europe and the monetary policy. And I think the most significant factor was Draghi taking over, where he said he's not going to let the whole system collapse.
Okay, so your framework is look at the broader political structure and consider what the downside might have been if you got somebody who was hostile and in a sense would take the safety net away.
Not only in Ireland, in Europe. In Europe.
Okay. Yes, in the center here.
Sorry, yes. So another sort of more narrower version of that is, I think Ireland was also under a lot of pressure to take the bailout money and eliminate some of their low corporate tax policies that were viewed as overly competitive by other European countries. So how robust, I guess, is the investment to a scenario where Ireland is given the bailout, but then has to radically change its tax policy in a way that all that expert-led economy might be stuck in a low growth or even a negative growth situation, right?
Is there a way to put some numbers on that? Has anybody thought about how you would take these scenarios and build them into a decision framework? I know it's Saturday morning. and you didn't come prepared to do homework. But that's the kind of question that we would move forward, take those ideas, and challenge you to think about the analysis behind these observations and questions about the basic deal. Yes, Paula.
Can you actually repeat the question from the start, because they wouldn't have heard you?
Okay, sorry. I had a question from an investment perspective. If there is a way that you could hedge the macroeconomic, for instance, if Angela Merkel and the euro decided that they were going to change or political regulations or the euro was going to go down, if there was a way somehow an investment vehicle that you could hedge the downside.
Okay, so we've gotten these sort of pessimistic macroeconomic perspectives. You're thinking we might be able to use the markets to hedge out some of that, and then the real value created is the value that is specific to the institution that we're acquiring. Okay. Now you can see we're building up great questions for Wilbur.
Taking notes.
Okay.
Ellen is right over there.
Ellen.
But I think what all of these comments are illustrating is the fact that being a contrarian investor is very difficult. It's emotionally difficult. There is just so much that you do not know. And at some point, you know, it's sort of a leap of faith. It's very difficult emotionally because lots of people are telling you, know, there's a lot of fear, there's a lot of unknown. And so I think what you hope is that the risks are asymmetric, as you pointed out, that, you know, there's the price is of Armageddon is priced into this. You know, it's a very, very good value. So you hope that there's asymmetric optionality in this. So yes, you might lose, but if you win pretty big. Mm-hmm. And so, but it's more, you know, there's a lot of emotional aspect of these types of decisions and just being contrarian because you can't know. You're in a unique situation that the world has never faced before.
And that's right. This was a moment when emotions were running very high. Time pressure might have been an issue, I don't know. But that's when decision frames may change. Yes? Millie?
My question is maybe a lower life form question for Wilbur. I'm a banker, we do lots of models. You have to make assumptions in models. You know, if you, in Armageddon, make an assumption, the question is how can you make an assumption that will allow a deal to get done in a situation like that? And if Wilbur can give any practical valuation guidance, because he's been the greatest contrarian investor I think I know, because I could see what those models would have looked like in Armageddon to the point where probably nothing could get done. So how do you just make the financial analysis decision? Is it in a kind of modified Monte Cristo method? Is it kind of, how did he figure out what he was prepared to pay, given that no normal asset pricing model obtains? But the models are always the same. It's a question of the inputs.
Yep. So that's what we would like to think, that the models, the simulation models, the choice of discount rates, the scenario analysis, we would like to think all of those really are tools that our students can use. And then the natural question is, here you are, the world has gone up in flames. How valid are those models? And if they're not valid, how can you make a decision where you're actually investing numbers and dollars into something? I'm going to turn to Madrid and see. I'm sorry.
Let's go to Dublin for just 1 second, because we've talked about models. We talked about this from the outside. What happens if the euro breaks up? The ECB's policy. If we get the perspective here from Ireland, what are we missing in our conversation? What are some of the thoughts or questions that you have? As Ciarán reminded us, there's a country, there are people. They have savings. What are your thoughts on this? Yes, please. Go right ahead.
Just a quick comment on the question that you asked, why wouldn't you invest? When the investment was made, the fundamental problem still wasn't solved, and that was that Irish banks did not have access to reasonable commercial funding. I'll use the example of CRH, for instance, would not leave their deposits with an Irish bank over a weekend. At the time the investment was made. Any shock to the global system would have obviously been multiplied on the liquidity issue of Irish banks, which would have exacerbated the assets and the value of the assets, which caused the problem in the first place. And there was a huge unknown. So it's not saying, oh, this is the problem and this is why I wouldn't invest. It's that there was a lot of unknown still. The confidence was still low. We couldn't access funds from other banks, and liquidity was still a big issue for Irish banks when the investment was made. The confidence wasn't there, and that's why I'd say investment would have been a brave decision.
Okay, so there's a classic trade-off in finance between uncertainty and risk, and I think what you're talking about is the magnitude of the uncertainty with respect to basic financial transactions had disappeared, and in that context, again, the question comes back to Wilbur. How can you be brave in a case where it looks like the basic institutional structure is disappearing? I'm going to turn it over to...
I was going to ask one question to Madrid. As some of you know, I spent 9 years living there. Whenever I see graphs that show, sort of Spain being the place where you don't want to go, I sort of need to be the contrarian myself. So, friends in Madrid, I mean, do you make a case that Ireland isn't the only opportunity here? That maybe there are great opportunities in Spain. Maybe Wilbur has a little bit of change left and is looking for some opportunities there. What's the situation like, and do you see opportunities?
Who wants to take it? Go for it.
Hi, Cameron Rout here from IE Business School. I noticed on the graph that was shown there was a surplus for Ireland pre-crisis that was very similar to the Spanish surplus pre-crisis. The post-crisis deficit was actually less for Spain than it was for Ireland at the time. And now, obviously, there are a lot of different contributing factors, but I wouldn't be surprised that if the experience of the investor had been similar in Spain with the precursory knowledge that they had from the previous investigations, that they may have found other opportunities that may have been just as attractive to a contrarian investor.
So let me respond partly to that. That I think is a good question. The graphs I presented are one way to get started. I tried to pull material that was partly in the case, but there are various filters you would employ here. In my part of what you might want to do with Spain versus Ireland. I hate to put a damper on Spain, but for example, the regulatory environment in Spain for getting out of this crisis is a lot more difficult than it was in Ireland. I'll give you a quick example. A friend of mine, his wife's a jeweler. She wanted to start up a jewelry store in Spain, in Madrid. Turns out there's a booklet of regulations you have to get. It's about this thick. In Spain, there's no similar booklet in Ireland, and the Spanish regulations include the size of your safe. So there are a lot of hurdles in Spain, I think, that you wouldn't have found in Ireland, and that might still, present a problem. But that your question is sort of the lead-in. It's like so you then start looking at all the other factors, I think, and that's one of the nice things about these cases. They're not actually complete. So there's a lot of room to then bring in material from other sources. That's one of the reasons, like, when I presented the material comparing Ireland to Iceland, that's also not in the case. But, you could imagine, like Will was talking about the regulatory environment, you could easily imagine students coming in and saying, look, here's what happened in other countries that took a different response to a similar crisis.
Rick Antle, Professor Rick Antle here at Yale SOM.
Another accountancy professor, by the way, Senator here. Actually, I think Ciarán basically preempted what I was going to say. If I was a contrarian, especially if I was an outside director or whatever, I would want a pretty good explanation for why we think we can evaluate this investment better than alternative, better than our competitors. What comparative advantage do we have of being the guys to come into this? I think that's crucial, because we could all sit in a room and kind of talk ourselves into our expertise, but to take a risk like this, you need to believe you have a comparative advantage. And
I think that's where Wilbur will have a view on that, but the investigation of the analysis of EBS before and Northern Rock, I think, gave it certainly a temporal advantage. And the other piece I'd say, I mean, this is back to calculations of context, if you like, is that the political environment in Ireland is actually very stable. So there was dramatic change at the last election. The previous government was, decimated effectively, but the government which came in behind was still followed more or less the same policies. It would look like the government that comes next, even though there might be a strong independent, contrarian view of the world, that would come in, it won't be a majority. So I think there's a strong middle class voting pattern and a very strong political environment. So in Ireland, there's that stability, even at the time of the investment. The question about Europe was interesting because that's a broader context. But I think part of the calculation would be that there was a government support, which I think would be very important in a broad sense, and government depended on the success of the investment. This was a poster boy investment for the economy, and that I think was a very important part of it.
Let me encourage the students in Dublin to jump in. Your dean is sitting here telling us everything is great and stable and happy. I mean, that's sort of his job to do that. What's your take on that?
I'm an optimist and maybe a contrarian as well.
Some thoughts from Dublin on this?
I suppose I would agree, obviously, with the dean, because I'm not a fool. But I suppose one thing that we have to bear in mind is the high debt levels that Ireland now has, and it's a once, as one of the professors said already, it was a once-off. Like what happened was definitely a once-off. But there's so much debt now in Ireland, and it's going to take us generations to pay that off, and that must have a negative impact on our growth long term. I would have thought. And that's basically all.
So the response to the crisis themselves then, of course, conditions the long-term upside in terms of the recovery. And that's a question as well in terms of your investment horizon, how that might come into play. Yes?
Can I ask, what is the unemployment rate in Ireland now?
Approximately 13% and falling in the last quarter.
Is that politically stable?
In the sense that there's very high social welfare support, so there is a very strong safety net. There isn't that level of unrest that you might see in other countries, so even though there's high unemployment, I think the real question is emigration. So outward migration is a significant problem.
We have a question right in the
middle.
middle.
They don't vote because they're gone, unfortunately. Yeah.
I would like to pick up on this notion that the role being played is that of the contrarian investor. It seems to be a point of pride and identity in the organization. So I'm wondering how decisions get made when that is the perspective, especially in an organization where I imagine there might be some tendency to agree with the dean, so to speak, internally to the organization. And in a context where the actual significance of any of the facts is really hard to establish. How do you avoid what you might call a groupthink kind of phenomenon, more like a deference, where people give a lot of emphasis to a fact being spun a certain way, and you begin not to question it because perhaps the senior authority figure has interpreted it in a certain way. It sounds like a standard solution for this is multiple advocacy, giving a role of the contrarian within the contrarian organization to one or more people. So I'd be curious about what kinds of steps were taken to avoid the pitfall of coming to complete agreement on facts that, on the meaning of facts that might actually be contrary to reality.
Okay, I think that comes back to the question of how do we use the other modes of analysis in the decision-making framework, but also it comes back to the question of what's the culture of the organization for considering different points of view.
Well, your question before about the unemployment rate also gives us another opportunity to go back to Madrid. It's 13% in Ireland. It's still at 25% in Spain. And youth unemployment, of course, being 45 or 50%. Not that question or comment from Madrid necessarily has to be on that topic, but just to remind people how serious the situation still is in many of these countries. Let's go quickly to Spain, and then we'll come to you. Questions or comments from there?
Yes. Here's another one to Mr. Ross.
Good morning and good afternoon to Ireland. My name is Alex Garcia at IE Business School. My specific question to Mr. Ross is, given governmental change in Spain, would a Spanish acquisition become an option, or would social factors play such a role that you would avoid the area?
Okay, so how do you weigh these various factors, please?
The major question I would have, actually, from both Wilbur's perspective as well as the Irish government perspective, would be one of the bidder for a distressed asset. And I think the major question in a circumstance like that is understanding the nature of the distress of the seller and what exactly is compelling the requirement for outside investment and so-called bailout funds at that point in time. What Ireland actually had done was effectively assume ownership of the bank. What kind of cash flow constraints did that put on government financing, such as requiring them to sell in the short term, or did they have longer term options, which in fact would have raised the bid required from Wilbur or any outside investor, or perhaps even obviated the need for a sale at all?
So in the preparation, Wilbur asked for a small pad to take notes. I wonder if you have concerns now that you should have asked for a bigger pad. I think we should actually turn it over to you because there's a lot of material already, and I suspect many or some of your comments will prompt additional questions, so it might be a good idea to hear from you, Wilbur, and then to go back to audience here as well as in Madrid and in Dublin. Please, Wilbur Ross, wherever you like.
Don't mean to turn my back on the overseas people.
But they see you from the camera right up front. So.
We start with a few things. I was very impressed at the Raw case. I went to Harvard Business School, as many of you know, and so I'm pretty familiar with their method. They've actually done 4 or 5 cases on other transactions we were involved in. And this one was far better prepared and far closer to real life than anything that I saw up there. So I congratulate the school for the philosophy of the Raw case and in this particular instance for the execution of it. A lot of the questions that were asked had to do with, well, how do you figure out that this makes sense to do? And therefore, I'm reminded of the famous quote from Yogi Berra that it's very difficult to make forecasts, especially when you're talking about the future. And so that's something that we do focus on. Our real methodology is that I serve as the town gripe, and the way we overcome the social issue of advocacy is I'm never the formal advocate for anything. In this case, it was Steve Johnson, a very good young man in our office. And it's actually my job to be the town gripe, to be the naysayer, and to try to flush out the work. So in that sense, you could say I'm a very highly paid professor because it's that kind of a process that we go through. We have a very big mantra, which is the only stupid question is the one you forgot to ask, because that's the question that will kill you. If you've thought through what the problems are, then you should be able to figure out, well, can I live with this? Do I have enough margin for error? Or do I?
Every discussion like this includes a Zen moment. All right, now let's get back to the numbers.
I don't know if that's an editorial comment or what. Should we continue or what should we do? Okay. So that's our process is we literally start out making one huge chart, everything we can think of that's wrong with the macro picture and the micro picture. And we really work very, very hard on developing that. And when we finally think we have our arms around all the problems, then we start work on another chart, which is to say, well, now what are we going to do? How are we going to overcome these issues. Not numbers at this stage, just conceptual approaches. And usually the charts are pretty big in both sides. And we did particularly focus on the macro questions because we've been investing globally for quite a little while. And we figured out a long time ago that you cannot micromanage your way out of a wrong macro decision. The macro wins, it overwhelms. So you got to have the macros. Oh, there he's out doing macro research on why we're not connected. So we start with that, and then we keep drilling down, drilling down, drilling down. But at the end of the day, you never do have enough information to be 100% certain of your decision. And that's not just true of turnaround investing. I think it's true of any kind of investing. You never have all the information that you'd want in an ideal world because the future is unknowable when you come down to it. So we're kind of resigned to the notion that at the end of the day, we have to just call the shot and either do it and take the chance or not do it. So how do you try to protect yourself? Some of the questions that were asked really related and intelligently so to that issue. On the question of Trichet, we assumed that if we got it wrong, there'd be nobody that would help us, not the Irish government, not the EU, certainly not the US government. And so we felt that we were out there in the fog bank and either we would get through it and make a safe landing or we wouldn't. We also felt, and I think it's one of the things that the many other investors who chose not to go into Ireland missed. We felt that given the fact that we immodestly believed that the four of us, ourselves, Fairfax, Fidelity Fund, and Cap Research, those latter two were passive participants in our group, we felt that because those firms are generally viewed as sensible people and are known to be global investors, that to some degree there would be a self-fulfilling prophecy of the investment. And what I mean by that is this. The reason that when the government guaranteed all of the liabilities, it didn't do any good, was people didn't believe the government was creditworthy. And so it was a symbolic act, but it did not change investor confidence. And when you think about a bank particularly, banks are really figments of people's imagination. There isn't a bank in the world that could withstand a sustained run by its depositors because they all borrow short and lend long, violating every fundamental rule of common sense. And indeed, we continue to do so in the banks that we're invested in. So the whole question is, can you create a situation where the bank and the sovereign had enough credibility with the outside world that they would regain access to the capital markets? And we believe that our event of coming in, coupled with me screaming and yelling on CNBC about it, would help and would start to change the psychology. And it sort of worked and sort of didn't work. And this is an interesting other aspect about turnarounds. Even one as successful as this, they don't go quite as smoothly as you would like. What went well was the day after our investment was announced, Deutsche Bank announced that it was reopening all of its former lines of credit to the government and to the Bank of Ireland. And then that led to a few others coming into the picture. On the other hand, the stock, which we bought at 10 euro cents a share, 30 days later was at 8. So we didn't get very much instant gratification. And we therefore also violated a fundamental rule of trading. I bought more when it went down to 8. We get very pig-headed when we make decisions, and so we thought if we liked it at 10, gotta like it a lot better at 8. Whether I would really have had the courage to keep doing that if it went to 6, I don't know. But fortunately, that question was never asked. On the issue of renationalization, our belief was that given the heavy indebtedness of the government, they would be more interested and it would be more politically important to them to repatriate the funds that they had in the bank. They were in the bank for billions of euros beyond the equity. They were elsewhere in the cap structure as well. So we felt that that was good in one sense, in that it meant that near term, they wouldn't be too discriminatory against us because they had a very big stake. And that as the thing turned around, they would be very happy if we could get them their money back. Well, they actually have now made point to point a profit out of Bank of Ireland, partly because they were charging us these huge fees for continuing to guarantee the liabilities. Partly we paid them a 10% coupon on way over €1 billion of paper. And then partly through capital markets, we've taken them out of everything but their 15% in the stock. So that was how we felt that. On the hedge, tax policy. We researched that very carefully because we were aware that the French, since they love high taxes, especially on wealthy people, would put pressure on Ireland to try to change the tax regime. And we were happy to find that in the EU constitution, the EU does not have the power unilaterally to force an individual country to change upward its taxes. I think they don't have the power to make them go downward either, but from our point of view, the upward. And we were quite convinced that neither the Irish government nor the Irish population would be in favor of changing the tax regime because it was so central to attracting foreign direct investment into Ireland. 1/6 of all the people employed in Ireland work for companies that have foreign direct investment. And that was the other part we felt was a good strength. The lion's share of Ireland's foreign direct investment comes from the US. US firms have invested $160 billion in Ireland, more than in the BRIC countries, in this little country of 4 million people. So the idea that government would do something untoward to fairly prominent US investors, we thought was far-fetched because it would have serious other implications for them going forward. So that was how we felt that. What we did do and what we always do, our investors basically are dollar denominated, so we always hedge the euro back to dollar. So that was not anything peculiar to here. Then the question, how can you model and how do you come to valuation? We think the models are useful and sensitivity analysis and all that. But to us, the fundamental flaw with models is they start out with the premise that tomorrow will look a lot like yesterday. And the problem is that at inflection points, the reason they are inflection points is that it turned out that tomorrow didn't look a bit like yesterday. So the models are useful as a guide, but the way we mainly use them is to say how much of a discount from tangible net worth are we in at, and therefore how bad can things get before A, our investment is impinged upon, and then B, before we take a complete loss in it. So we're more worried about that, how much room do we have for mistakes, than we are about the upside. Because we figured out a long time ago that again, unlike what people sometimes think, we believe the less actual risk that you take, the better the opportunity for reward. Now that may sound silly in this case, but we felt that given the macro factors that were involved, given the timing where we were, that it was essential to the EU, maybe even to the whole world, to have Ireland be the first one to come back out. So that was why we picked Ireland at that point rather than the others. And those reasons were pretty fundamental. the government historically had functioned very well. During the boom period, Ireland had a fully funded national pension fund, something I wish our government would give some thought to. It had favorable trade balance, huge foreign direct investment, young, well-educated labor force, very good telecom and transportation infrastructure, the only English-speaking country using the euro currency, and most of all, a population that by the time we came in had already proven that they were willing to put up with a lot of problem, a lot of cutbacks by government, without riots, without car bombs, without nationwide strikes. So they had already shown that the sociology of Ireland was clearly different from that in the Mediterranean countries. So those were the kind of big picture things that we looked at. Next question, what about Spain? As the people in Spain, at least some of them are well aware, we are in fact looking at Spain. This is now 2 years later. Lots of other things have happened. The idea of EU dissolving is no longer very topical. So some of the cloud banks have cleared at the macro level. There still are issues at the Spanish level itself. It is continuing to be a very bureaucratic government involvement. There is the issue of who really controls money. Is it the provincial governments or is it the federal government? That's an ongoing saga. But the other thing that really intrigues us right now about Spain, if you walk the streets of Madrid, you walk the streets of Barcelona, you don't see beggars. I can't imagine a country that allegedly has 25% unemployment and 50% youth unemployment, but you don't see any beggars. It's not like a Mexico City or some of these other places. So my only conclusion is that there is a big enough gray economy in Spain that a lot of the people that may be technically reported as unemployed perhaps are not really so. So we're continuing to research that. But it's the only way I can explain that my eyes on the street don't seem to agree with the macro statistics. Then the question, why did Ireland need the deal? The answer is a pretty simple one. They were being put already on a very tight leash by the EU. They already had too much debt. So the last thing they needed was another €1.6 billion euros of debt at that point in time. And you must remember it in context as well. A year before, they had done another rights offering, and that one was at 35 cents. Now we're at 10 cents. So for all they knew, the next one would be at a nickel or 2 pennies or a halfpenny or whatever. So they had plenty of reason, both from a risk aversion point of view and from a simple funding point of view, a liquidity point of view, to do it. Lastly, the government recognized, at least when I spoke to them, they recognized this concept we had, that fancy foreign investors coming in a very, very big way at that precise moment in time would change the game and would in itself be an important economic fact, not only for the bank, but for the country as a whole. And so they got it. For a while I was worried they were just saying that to suck the money out of us, but I think they did believe it, and in any event, we did believe it. I think those are the questions that were there. I'd like to talk a little bit about turnarounds in general, because many of the kinds of questions that were asked relate to any kind of distressed investing. Leading a turnaround is inherently an oxymoronic activity. And what I mean by that is this. What do you have to do simultaneously? You've got to cut costs, but build morale. Not an easy trick. You must be skeptical, but optimistic. you must be a disciplinarian and a visionary. Those things really don't fit very well together, and so it's a hard thing to do. And that was the last thing that we found important here, even though at the time and to some degree now, the CEO, Richie Boucher, was and is somewhat controversial. We felt that he was exactly the right person to lead the institution out of the problem, that he would be able to work his way through the deals with the unions. And we've gone through massive voluntary reductions where people got paid to leave. Thousands of jobs were made redundant in that fashion. And he was able to work with the unions constructively twice to modify the pension plans to make them a little bit more affordable. And in Ireland, literally, you have to not only get the union on board with that, you literally have to have each individual worker sign off on changes to the pension plan. So we had 90-some-odd% acceptance each time of people accepting the premise that in order to protect the pension plan overall, they really had to make some concessions. And that amounted to about €1 billion of change in the picture. It's a big number. So we felt that Richie was the right guy to do it. And I think subsequent facts have kind of borne that out. Ireland has regained access to the capital markets. They did an issue last week on a very cheap basis. Bank did another issue also last week on a very cheap basis. Stock is at 30 cents, so all is well for the moment. So it turns out the naysayers were wrong. I'll be glad to answer any follow-up questions that people might have. Yes? Oh.
I have a question.
Quickly go to both places, and then we'll do some follow-up questions here. Quick comment or follow-up question from Madrid, then we'll go to Dublin, and then we'll stay here in the room after.
Go for it.
Yeah. Hello, good afternoon, sir. I would like to address a question to Sir Wilbur Ross. So we all know that construction crisis hit hard on Ireland, such as in another MED countries, such as Spain. However, probably some positive things might be left, such as construction know-how. And if we take a brief look at the top 100 international constructors by revenue, we see that the first world constructor company by revenue is a Spanish company, Grupo ACS. And in the top 100, we have 9 Spanish companies, 1 Portuguese company, 1 Greek company. So in terms of top 100 international constructors, we have 11 Met Club companies, but no Irish company. The first Irish company that comes in, if I'm not wrong, it's CIS Group. So we might see here an opportunity. Why not start to support Irish constructors to export know-how and go overseas? Maybe through the Bank of Ireland. And by the way, my name is Armando Nunes, and I'm from Yale Business School.
All right, so we collected a couple of them for the O2. Comment from Dublin, anybody looking for construction opportunities? Nope. All right, question, comment from Dublin?
Can they hear?
I thought they could hear.
Yep, good, yep. Man at the front there.
Wait a second, what is now? Okay. I think you might be on mute locally. Can you make sure your microphone is unmuted locally in Dublin? All right.
There we go.
Yeah.
Okay.
I was just wondering what, if any, what influence Ireland's membership in the euro had on this decision, given that on one hand, I suppose it meant that we didn't have any control to devalue our currency or anything to potentially expedite our recovery, but on the other hand, I suppose that it gave us a web of support in Europe that we otherwise wouldn't have had.
And I just want to know what the original underwriting for the deal for the investors were and what you expect your investors net to get out of this on a multiple basis.
Okay, I'll answer the last question first. Our objective always is to achieve more than a 25% IRR. That's what we promise to our investors. So if we don't think we have a good shot at that kind of return, we don't go in. And what happens in the real world is some way outperform that, some way underperform it, some don't even make a return. But it's pretty well worked out to that kind of a number or better over the years. In terms of the construction question, I don't know enough about global construction to give you a sensible answer. Maybe that should be a separate case study jointly by Madrid and Dublin. I just don't know enough about it.
Okay. And the Euro membership, sort of how that cuts both ways potentially?
Well, we had assumed that the Euro would not break up. That was one of the 8,000 assumptions that we made. And we felt that at worst, that they might kick Greece out. But we didn't see that that would be the be-all and end-all because that was such a small economy. And as you know, that whole discussion has sort of evaporated. It doesn't seem like there's any likelihood of it. I do think that they still have some problems to solve, but they've solved quite a few in the EU. Remember when they started out, you had this weird situation where countries gave up monetary policy to the central authorities, but they retained total control over fiscal policy. So we had a very weird situation. Gradually, I think you're going to have the consolidation of that more into a centrally controlled thing. Think how the US would be if every state could set its own fiscal policy. This would be quite a zoo. Yes, Ted?
Wilbur, thank you. And it may have already been raised, but when you said you don't know, a lot of people don't say that in response to the question about construction. And I thought you might want to remind people a little bit about the length of time that you put in before you make an investment.
Okay. Yeah, we generally look at things a year, at segments, whether it's a country or an industry segment, for a year or two before we begin to commit any funds. So we spend a lot of time trying to figure out what's going to go bad next so that we can get ready for it. My wife describes it as always looking at the wrong end of the telescope, but anyhow, that's what we do. And so we're very aware of what we know we don't know. What scares us is what we don't know that we don't know, as I mentioned. So when we don't know something, we just don't play, and we're perfectly willing to acknowledge that. It's hard enough to do a few things right, let alone pretend to do everything.
Well, I hope we've given you a sense of what a raw case discussion is like. I've enjoyed this tremendously. I want to thank our three faculty leaders, Ciarán O'Haugartaigh, Matt Spiegel, Will Goetzmann, as well as Erica and Tony in Madrid and in Dublin. I want to thank the students there who came out on a Saturday. I hope you enjoyed this session. It was a very innovative, partially unscripted approach to teaching. It's a little bit scary at times. When you experiment like this, not everything works out perfectly. We quickly lost the network connection, but I think overall it was quite exciting to have people there. And of course, most importantly, thank you to you, Wilbur, for coming, for even before then working with us, giving so generously of your time, letting us document this extraordinary project and preserving it really and making it a set of opportunities for our students to learn from everything that you've done.
Well, good. I enjoyed the whole process. Thank you.
Wonderful. Thank you so much to everybody involved.